Now going to get into conversation with Sumit Kumar, Real Estate Research Analyst at JM Financial. Thanks so much for joining in. And I just wanted to get an overall sense from you in terms of, the kind of trends that we're seeing within the entire real estate space. The fact that we have seen an uptick in demand as well as in pricing. Would you like to break it down for us in terms of some of the observations that you've made, perhaps city-wise, where we're seeing the pricing trends having seen a huge delta?
Uh, First of all, good morning to Team ET Now and to all our viewers. And thank you for having me on the show. Let's go back a little bit. In FY22, the real estate industry actually started the green shoots of recovery. It grew by around 38%. In F23, the number was 51%, although on a low base because we were coming from a COVID lockdown. And F24, as we've highlighted in our report, the home run continues. The industry level growth was around 30%. This broken into two components. Volume growth was around 20% and price growth was around 10%. And this is for a pan-India level for the top 7 cities that we cover. Now, going forward, we expect roughly around a 12 to 14% volume growth for this year and pricing growth somewhere in the 6 to 7% range, which means the overall industry will probably be growing at a 20% top line for FY25. And we have to be mindful of the fact that the first quarter was a little weak quarter because of heat wave. The footfalls at the project sites were lower. The election impact, the approvals didn't come through, and hence supply for the launches were muted, and hence obviously absorption took a hit as well. In that backdrop, I think a 20% growth looks robust. If you look at the market share gains of the listed or the tier one developers, that has continued last year. From a sort of the 15 top developers that we track, the pre-sales have grown at around a 42% kind of a number against a backdrop of a 30%. So this we expect will continue, and sort of overlaying the numbers in the past, we expect the developer universe, the top tier and the listed ones to probably do a 30% kind of a revenue growth. To come to the second part of the question, which is basically the cities, I think in terms of pricing, Delhi NCR has been at the top, followed by Hyderabad and then Bangalore. The overall price growth in the last 5 years, from CY19 to CY24, whatever we've seen, is roughly on a pan-India average of 40%, where Delhi is almost like 2x, so it's at the top of the pack. Then Hyderabad, it's somewhere around 1.8x. Mumbai is probably on the lower side at around 40%. It's close to the national average. So that has been the split. Volume growth wise, I think we all know MMR is the largest market today in the country with around 40-45% share. The top market in MMR being Thane in terms of volume. And then you have Pune, Bangalore and Hyderabad to follow.
Sumit, that exactly is the point, because, real estate is no more a region-specific story, and I'm talking only about the listed universe, because the mighty big players have all diversified. I mean, the Delhi players are now in Mumbai and Bangalore, and the Bangalore ones are now out here in Mumbai, and, it's becoming more of a pan-India story. So how is it that you figure out which realty stock to actually invest in?
So I think this geographical expansion is a natural extension of your growth story. Obviously, understand real estate is a very localized affair. The supply demand dynamics vary across micro markets. Not even in the city, a South Central Mumbai can have a very different dynamic compared to Thane or a Panvel. But I think there is sort of a space for each and every credible player out there. If you look at what's the market share of the top 25 developers today, it's around 20%. And this is the data that I'm quoting from Prop Equity. The number will range from 20 to 30, but the point is the organized segment is probably at 1/3 of the total market, and that's growing. So there is space for any developer worth his salt who knows how to run a decent selling and marketing game that can get the approvals in a timely manner and execute the project in a timeline of 3 to 4 years. So it's all about managing your working capital well, not really going too aggressive on capital allocation. And to be fair to all the listed players, they have actually deleveraged their balance sheet, helped by obviously the cash flows that have come through in the last 3 years, helped by good pre-sales numbers, and supported by valuations. They have raised money as well. And they've also not really spent aggressively on land acquisitions. If you look at most of the business development that has been done by the developers, it's largely through the asset light route through JDAs and JVs. So to be fair to them, they have been what you can say prudent on the capital side, and obviously there is an industry upcycle that everybody has benefited from. So players with a decent track record of execution, players who have invested smartly in business development, and have the capability to do land deals because of economies of scale, scope, or they have a brand power, so they attract a pull. The landlords are willing to work with them. These kind of developers will probably outperform the entire industry, and that has happened, and
Yeah.
we expect that to continue.
Let's get specific as well in terms of, stocks and companies that are specific to different cities. For example, Delhi NCR, because a lot of projects really seem to be selling out over here. That's the discussion as well that we had with some of the managements. There's lots of co-working spaces. The IT hiring has been a big factor for Bengaluru. So for players like a Prestige Estates or other players that are dominant in that region, what's your outlook in terms of what could influence the price movement of some of these players?
So I think it's in terms of the 4 asset classes that we generally classify real estate into, I think residential is doing the best today. Office still in a recovery mode, and retail, we've seen some growth in consumption that has moderated. Warehousing, obviously, from the highs that we saw in the COVID period, there's some bit of a sort of a muted environment right now. In terms of cash flows, I think the coverage universe that we have, as well as the top 15 developers, they have delivered good growth on pre-sales. We expect the collections to grow in a similar manner, and the gross operating surplus looks healthy for most of the listed developers, barring a few. I expect collections to also move in the same line as pre-sale, which is roughly around 25-30%. On the commercial side, it's still in sort of slow path to recovery, though we've seen certain players where the occupancies have started to move upwards of 90%. They'll take another 2-3 quarters to reach occupancies which were at the pre-COVID levels of around 95%. And that gives you a massive operating leverage from the flow of security deposits and the incremental rentals that come in. So that will also help. But from a listed coverage perspective, I think there are a few players that have a diversified profile, and you can also look at them to probably make a public market investment there.
Great to have you on the show. Thank you so much for highlighting where is it that you see opportunity within the listed arena from real estate.
If you like this video, then like, share and subscribe to ET Now.